The recent announcement of fresh tariffs by US President Donald Trump has triggered significant volatility in global markets, with India's stock exchanges experiencing particularly pronounced reactions. As trade tensions escalate between the world's largest economy and its trading partners, Indian investors and businesses find themselves navigating uncertain waters with far-reaching implications for various sectors and the broader economy. Understanding the new tariff regime. President Trump's latest tariff announcement represents a significant shift in US trade policy, targeting key Indian export sectors including information technology services and software, pharmaceutical products and generic medications, textiles and finished garments, automotive components and specialized manufacturing, and agricultural products, particularly rice and specific spices. These sectors collectively represent a substantial portion of India's export portfolio to the United States, with bilateral trade between the two nations exceeding $150 billion annually. The new tariffs, ranging from 10 to 25% depending on product categories, mark a departure from previous trade relationships and align with the administration's America First economic approach. The announcement triggered an immediate sell-off across Indian equity markets. Benchmark indices, the BSE Sensex and Nifty 50, experienced their sharpest single-day declines in recent months, with technology and export-oriented sectors leading the downward movement. IT stocks faced particularly severe pressure, with the Nifty IT index recording a significant decline as investors reassessed revenue projections for companies deriving substantial income from US clients. The Indian rupee depreciated against the dollar, adding another layer of complexity for companies with dollar-denominated costs or debt obligations. The market reaction reflects not just the direct impact of tariffs, but also the uncertainty around potential escalation and retaliatory measures, notes Rajiv Mehta, chief economist at Global Financial Research. Investors are pricing in both immediate effects and second-order consequences. The tariff announcement has created varying degrees of vulnerability across different sectors of the Indian economy. Information technology services, India's IT giants, which derive between 60 to 80% of their revenues from US clients, face significant headwinds. Companies like TCS, Infosys and Wipro saw their stock prices decline sharply as investors calculated the potential impact on profit margins and growth projections. The tariffs could potentially accelerate existing trends of nearshoring and increase pressure for establishing more US-based delivery centers, fundamentally altering the sector's operating model and cost structures. Pharmaceutical exports. Indian pharmaceutical companies, which supply approximately 40% of generic medications in the US market, also face substantial challenges. While essential medications might receive exemptions, many pharmaceutical products could see immediate margin compression. The pharmaceutical sector faces a complex balancing act, explains Dr. Sanjay Patel, healthcare industry analyst. Companies must navigate price pressures while maintaining regulatory compliance and quality standards across markets. Manufacturing and automotive components. Specialized manufacturing enterprises exporting components for US automotive and industrial applications face direct tariff impacts. Many of these companies operate on relatively thin margins and lack the pricing power to absorb additional costs without affecting competitiveness. Broader economic implications. Beyond immediate market reactions, the tariffs could have several medium-term economic implications. Export competitiveness. Indian exporters may face challenges maintaining market share in the United States as alternative suppliers from countries without similar tariffs gain price advantages. Job market effects. Export-oriented industries employ millions of workers across India, and sustained trade pressure could eventually impact employment levels and wage growth in affected sectors. Investment sentiment. The increased uncertainty may delay capital expenditure decisions and foreign direct investment, particularly in export-oriented manufacturing facilities. Current account dynamics. Reduced export earnings could pressure India's current account balance, although lower oil prices might provide some offsetting benefits. Policy response options. The Indian government and central bank have several potential response options to mitigate the impact. Diplomatic engagement. The Ministry of Commerce has already initiated high-level discussions with United States trade representatives to seek exemptions for specific product categories and negotiate potential compromises. Historical precedent suggests such negotiations could yield partial concessions, particularly for products without ready United States domestic alternatives. The government might introduce targeted fiscal support for heavily impacted sectors, potentially including export incentive enhancements, tax relief for affected industries, accelerated depreciation allowances for new investments, and special economic zone benefits expansion. The Reserve Bank of India may consider adjusting monetary policy if the economic impact proves substantial, potentially through liquidity support for affected sectors, interest rate adjustments if growth projections deteriorate, and foreign exchange market interventions to manage volatility. For investors navigating this challenging environment, financial advisors suggest several approaches. Sector rebalancing involves reducing exposure to highly vulnerable export-dependent companies while increasing allocation to domestically focused sectors like infrastructure, consumer staples, and utilities. Quality premium means prioritizing companies with strong balance sheets, pricing power, and geographical diversification beyond the US market. Valuation discipline is about using market volatility to accumulate fundamentally strong businesses at attractive valuations, particularly those with limited direct exposure to US-India trade tensions. Diversification ensures portfolio exposure across different asset classes, including fixed income, gold, and selectively chosen international markets. Looking forward, investors should watch several key indicators to gauge the evolving impact. These include diplomatic developments and potential exemption announcements, company-specific guidance on revenue and margin impacts, changes in US sourcing patterns and contract renegotiations, Indian policy responses and support measures, and currency movement between the rupee and dollar. While the new tariffs undoubtedly create challenges for specific sectors and the broader market, historical perspective suggests that initial reactions often exaggerate long-term impacts. Indian companies have demonstrated adaptability to changing trade environments, with many successfully navigating previous periods of protectionism. For patient investors, the current volatility may ultimately create attractive entry points in fundamentally sound businesses temporarily affected by trade uncertainties. As India continues its broader economic growth trajectory, driven by domestic consumption, infrastructure development, and service sector strength, the long-term investment thesis remains intact despite short-term headwinds from changing trade dynamics. As markets digest the full implications of these policy shifts, maintaining investment discipline while selectively pursuing opportunities created by market dislocations may prove the most effective strategy for navigating this complex environment. Timecode 00070000007 super hash Trump tariffs hash Indian stock market hash trade war hash global trade hash India US relations hash export sector hash market volatility hash investment strategy hash economic policy hash AT stocks hash pharma stocks hash emerging markets hash stock market analysis hash trade policy hash investor education on screen text list of hashtags to be displayed on screen.